Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Inflation: Why are food input prices falling but grocery prices rising? You've surely noticed the grocery price increases at the checkout, but did you know that most agricultural commodity prices have actually been falling over the last year? Today, we're going to look at what's going on here and who's profiting, because the consumer certainly isn't. Today, as always, we have Damien Klassen, Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hey, Sam. How you going?
Good, thanks. My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal financial situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with me to have a no obligation chat. We are live every Thursday at 12:30 Sydney, Melbourne time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show is available on all the majors. So, Damo, that's the housekeeping done. So over to you to get the ball rolling.
Thanks, Sam. Yeah, so what we really wanted to dig in today into was some of the thoughts on inflation, and particularly food inflation. And I think this is partly a microcosm, but it's sort of this mystery that's going on, and we're getting sort of different data from different places and trying to work out which is right, and where does this when do we actually start to see food inflation come off? So what I've got up here is the UN Food Index. And so what they look at is they look at the raw prices of commodities. And they show them a bit weird, but because there is some seasonality to it. The chart on the left is showing the food price over time. And each line is a different year. So that the top line there is 2022. And we basically had it go from 135-ish. The Ukraine war broke out, jumped to 160, with the whole thought around they're quite large wheat suppliers and other foods. And so the thought was, that we're going to see all this extra food inflation, and that was sort of going to be locked in and keep going. But what we saw is, after 6 months, that just faded away completely. And we've started 2023 down significantly on 2022. We're also down on the end of 2021, not as low as sort of where we were at the start of 2021, but we're not we're sort of about the same average as what we saw in 2021. And then you sort of look at the individual one. So just the chart on the right is just showing some individual items over the last 12 months. And so vegetable oils is down well over 50%. Cereals are down sort of 25%-ish. Dairy's down sort of 10 to 15. Meat's down 10 to 15. Sugar is the one thing that is increasing. There's sort of some issues in terms of Brazilian production and things like that. Sort of and energy prices that's led to a higher sugar price. But by and large, you sort of look at that and you go, well, there's no more food price problem. You look at food prices over a longer term, and that's the next chart we've got, and you can see that basically real food prices don't go anywhere. If anything, they sort of spent, well, the last whatever it is, 60 odd years that we've got here, largely in the same band on a real basis. And then you go, okay, now what's happening with actual food inflation? And I'll pull out the US one as an example here, and we can see that that does not look like the same chart as what we've looked at prior. So this is sort of showing that we're basically seeing this acceleration in terms of food inflation. It has started to fade off a little bit in the most recent months, but it's certainly nothing like what we're seeing in that UN Food Index with looking at the raw prices. You look at UK, same thing. So we've got food inflation sort of running at almost 20% in the UK versus sort of 10% CPI there. So running at basically double the normal rate. So there's definitely something going on between the farmer and the end consumer. And so we looked at we actually did a bit of a deep dive maybe about a year ago into this sort of life of a farmer type thing, looking at farming costs and they're quite detailed. You can get breakdowns of producing different crops and all that type of stuff, because we're trying to work out, is inflation transient or not? And really, within the farming cost, we couldn't see a lot besides fertilizers that had really made a big change. And now that we've seen gas prices come back down, fertilizers prices are coming down as well. And so, it's sort of that sort of whole analysis became a bit moot, though, because then we saw wheat prices and all these cereal crops, decrease significantly from where they were the last year. So sort of the farming side and the costs there don't really seem to have changed in a marked way, enough to sort of justify much higher prices, and that's sort of what we're seeing in the UN index. So then the question comes back to, well, why are consumers still paying more at the shopping center? And so I've got here the latest update. This is from the overnight data of the US food inflation. Just because I find this chart, and for anyone who hasn't seen it before, quite sort of useful in terms of seeing the difference in inflation, in that I've got food broken up into all its different categories that the US has, and most of these are this food at home categories. And so the leftmost ones is the 10-year, 5-year, and 3-year annualized inflation up to December 2019. And you can see that all these were in either deflation or very low inflation for each one of these goods. The one difference was the food away from home, sort of running at 2.7 to 2.9%. And that's your restaurants and eating out, and an element of that is paying higher wages, but I think as well there's that whole services versus goods where we've really had deflation or certainly very low inflation in all that food versus some of the services that are a bit higher. And so that's all consistent. Then we got this huge burst of inflation that came through. In this next one, if we're looking up to April 2023, the 3-year inflation rate on food is sort of 6.4, and the 12-month is 7.6%, and it's pretty pervasive through each individual category, is all pretty much all rising as well at the same time. The last sort of 6 months and the last 3 months, we're starting to see a lot more red come through, and then the most recent months, they're mostly those red colors where we're either looking at negative or quite low rates of inflation for most foods. So maybe there's a sign it's slowing up, but still we're certainly running at sort of 7% plus inflation for food to the consumer. Whereas we're looking at this UN food price index sort of down 10-15%, depending upon how where you're measuring it and within which categories. So then you go, okay, well, what's to blame for this? And I think the companies, if you talk about it, will talk about transport costs and as being one of the key factors. And you look at transport costs, and I've got another chart up here just sort of showing the Baltic Dry Index, and that's down. From its absolute peak, it's probably down 70%. It's very much back into the range that we saw prior to this latest sort of outbreak of higher prices. Now the Baltic Dry is that's a bulk. They're bulk carriers, so that's a lot of your grains and things like that. So that sort of might make sense as well, in terms of maybe it's not in the bulk stuff, maybe it's in the actual packaged goods that's causing the problems. And then so you look at container freight rates, and they've done the same thing. There's here's a line sort of going, the average container freight was sort of $10,000, and is now back down under 2. So again, an 80% fall in the freight rates over the last little while. So again, that sort of doesn't match up with why we're still looking at higher prices. Packaging costs is the other one. Is a lot of the higher energy prices we were seeing were flowing into higher packaging costs, and sure, packaging costs were sort of running at 25% for a while there, but again, they're back below zero. So again, that's not doesn't seem to be a proximate cause for why we're seeing so much food inflation. Now there are some other explanations, but I'll let you go first, Sam, to talk about.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So, there's a number of people have made different suggestions about it. Then now one of the theories that's going around from Corfu LLC is this idea of price over volume. And so the idea there is that really what companies have been doing is increasing their prices, but actually selling less as they're going. So if you look at, say, and I've got a few examples up there from the latest reporting season. So Nestle, organic growth of 9.3% was in terms of sales, but their prices rose by 9.8%. So basically they sold less but charged more for it. Procter and Gamble, this most recent quarterly numbers, they grew by 7%, but actually they increased their prices by 10%. So volumes actually shrunk by 3%. And so Nestle and Procter Gamble both, sell a wide array of packaged goods, ranging from whether it's food or sort of, all your sort of household products and things like that as well. Coca-Cola, the same type of thing. Net sales up to 12%, but volume declining by 1.1%. So there's certainly this idea that really what's happening is companies are really just pushing prices as far as they can and saying, well, if I increase prices by 10% and my volumes go backwards a little bit, well, that's a good thing in a way, because it means that I should be spending less on whatever I'm producing, and I'm getting this massive profitability. So see the excuseflation or the idea that because the meme of inflation is so widely spread now. A few years ago, if you tried to shove through a 10% pay rise, people would look around and go somewhere else. Whereas nowadays it's like, well, there's inflation everywhere, so maybe you're right. And so that seems like a reasonable explanation for it. But so some people call it a greedflation. However, it does get a little bit dicier once you actually start digging into this in terms of the explanation. So I've got a chart here just sort of showing Pepsi, and this is again same from this idea of price over volume. The grey line is the orange line is the total change due to the total increase in sales due to pricing increases, and the blue line's the volume changes. So you can see that the orange is getting bigger and bigger as a percentage of that as they keep jacking prices. Coca-Cola, similar type of story. There's some currency effect they've added in there as well. So, but again, that same type of story. So, what that sort of would say to an investor at face value is, okay, I've got to have a lot more of these consumer staples, and we've obviously been pushing. We've got a number of them in our portfolio, and we've been pushing the line that you want safety, and so consumer staples is a good place. And that is true to a certain extent, but don't go there expecting sort of massive increases in revenue, because once you start looking at massive increases in profits. So we're getting revenue increase, but actually margins are actually shrinking. So I've got a whole bunch of different sectors up here, just sort of on some charts, just showing the blue line, and you can see that almost every sector had this sort of bump in recent years. This is like about a 20-year chart in terms of the numbers. But you can see over the last couple of years, coming out of the pandemic, there was this big increase in margins, but that's all faded off and it's starting to shrink now. And so these are looking at total profit margins. So that can be influenced, but by other things. But I'll dig first into the ones we care about, these consumer staples companies. So that was just the top. That sort of all those individual charts was just a whole bunch of individual sectors showing you that, look, it's broad, it's widespread. Yes, margins rose, but now they're falling. Now, if we dig straight into the consumer staples sector itself and look at some of the individual ones. So again, this is sort of showing over 20 years. Each of the different lines, tobacco at the top, soft drinks is the yellow, basically going sideways. It rose a little bit into 2018-19. It basically done nothing for 2023, and soft drinks is largely the companies we're talking about, Coca-Cola and Pepsi. You look at brewers, one by one through those sectors, and then we jump into the next group as actually I must have skipped a chart. There's another chart I had of other ones that I've inadvertently left off this, but the story is the same. Margins are not growing, the profit margin for these companies. So there's a couple of reasons this could be. One of them could be interest rates. So profit margins include that. They include interest rate. They include tax rates as well. So that can sometimes skew your profit margins, but not as much of an issue for us at the moment because we haven't been seeing changes. So what we want to look at for that is we want to then go and look at further up the line and say, okay, well, let's try and work out what's going on at the sort of at different levels of the balance sheet. And so
hey Damo, we've got a really good question here from Pete Beaumont, and he's asking when OPEC cuts production, how long does it take for that to register at the Bowser? And because I know a lot of people fuel prices have been elevated for a while, so is that a factor?
Yeah. So it certainly is a factor. I mean, they have come off from they've come off their levels in US dollars. So that's the other problem for Australia, is that the currency plays a huge role in terms of if we have stronger or weaker currency can really affect fuel prices as well. And then there's refining margins that sort of sit in between. And so refiners have been taking larger margins. And so some of this is so I guess the basic answer is, look, you're probably talking 3 months-ish, but it can be sooner, it can be later, depending upon inventories and how people are seeing the market and what they're doing in terms of the discounting and what they're trying to run down at the time. I think there's and that's true of a lot of the things we've spoken about as well. So I spoke about lower transport costs. I mean, the question is, which is sort of unanswerable really from a big picture perspective, is are there lots of companies maybe that have gone out there and booked in for transport costs for at the peak of the whole you'll never be able to transport anything ever again, it's $10,000 a container, you'll never get a shipment. Did they go out and forward book the next 2 or 3 years at elevated rates in order to get it? And so now they're still paying those rates, even though the spot rates have come down by 80%. Maybe companies are still paying those old rates, which is quite possible, and well, it's certainly true in some cases. And this, how widespread it's hard to tell. And similar with packaging, packaging costs, they're still paying the higher prices. Yes, the latest ones are coming down and are now negative, but you've got packaging left over from that you bought. You ordered 6 months ago or 12 months ago, and it's still sort of flowing through. So that's entirely possible as well. And if that's true, then we are looking at some pretty sharp decreases. And I guess that's probably part of that whole story that I'm trying to get to is, the answer may well be that we're just backed up in terms of all these all these fuel costs and transport costs and packaging costs and wage rises and things like that are all sort of bundled up and passing through the system, but they're just delayed in that we're at the shop front, we're still seeing the packaging prices from 3 or 6 months ago, and we're still seeing the transport costs from 3 or 6 months ago, and that's possible. It is also possible that companies are just trying to hold on to these that they've basically gone, okay, we have these higher costs, we're going to try and hold on to them as long as we can, and it will take an economic downturn before people stop buying things, or it will take changes in consumer behavior before, say, Coca-Cola says, well, we keep putting through 10 or 15% price rises, and people keep buying Coke. The day they stop and they start buying, a different brand of your home brand or whatever it is, maybe that's when they relook at their pricing policy and start to bring it back.
Excellent. I think that's a good answer.
Now, I'm going to jump past a couple of slides up to this organic sales result. So we're looking at this margin issue and we're saying, okay, well, we want to try and work out what's going on here. So I'm going to dig into Procter and Gamble that reported not that long ago. They've got these organic sales growth, and you can see here that the blue lines are last year, where they're sort of doing started at 4% growth in the first quarter and as high as 10% growth in the third quarter, and then they've been sort of running at 5 to 7% for the last 3 quarters. And again, they're talking about that point that their actual pricing was 10%, and then their volumes declined by 3%. That sort of left them with that number. Then you look at the earnings per share growth, which is the next chart, and that doesn't look nice at all. Like that's the first. So despite these price rises, first quarter they lost money. Their earnings went backwards by 2%. Second quarter it went back by 4%. A 3% rise in the latest one, but it's certainly not. It's not showing this amazing picture of Procter and Gamble shoving through price rises and laughing all the way to the bank. They're really not, they're not sort of massive increases. One of the things they do show on this is that their gross margin is up 1.5%, and so that's sort of something that's worth digging into. And so I've got a chart here and showing both the gross margin and the operating margin. So to put this in perspective, you've got the profit and loss, and you're going to work through that to see as the costs come out. So the first thing is you start with your sales, and that's that's a relatively fixed line for most companies, and there's you can't muck around with that too much. That's you sell what you sell. Then you have this thing, cost of goods sold, and so you go your sales minus your cost of goods sold gives you your gross margin. Now, your cost of goods sold are meant to be things that are like a direct input into the actual production of that, and that gives you some sort of margin, what's called a gross margin. Now, in the idea of a Procter and Gamble or someone like that, what it's effectively saying is, you've got your sales, you take off the cost of the goods that you've actually sold, and that gives you like a margin of sort of 50-ish%. And then after that, then your next one is now you go in and deduct things like your depreciation, a lot of your operating costs, your marketing costs, and other things like that, all the other parts of running a business, and that gives you what's called an operating margin. And so if we look at Procter and Gamble again over the last 20 odd years, we can see that they certainly went in 2020 and 2021. There was a massive margin increase. So they went from operating margins of 20-ish%. All the way up to 25, 26%, but that's coming back down again. It's over the last year, it's fallen from 26% back to 23%. So that's not the story. The gross margin, so just looking at the the cost of goods sold, actually that's plummeted in the last little while. They've gone from sort of a 50-something% gross margin back to a 47% gross margin. So small tick up in the most recent quarter, but it's certainly not a story of making this massive, of keeping their costs steady while they raise their prices, and sort of laughing all the way to the bank, so to speak, in terms of that. So that's Procter and Gamble, but it is only one company, and there have been the currencies actually moved the wrong direction for them. So that might be sort of playing into some of those margin figures, but I might throw to you, Sam, and then we'll talk about some other companies.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
So Procter & Gamble is one of the largest in that space. They're a US-based one. But look, all these companies are international, but they report in US dollars. So I thought I'd jump and let's look at Nestle. Now they report in Swiss francs. So again, they might have some different currency issues, but it's exactly the same. Where we're seeing the gross margin, and the other thing the other thing I should get to with gross margins is gross margins are not a particularly comparable number between companies, because companies can decide really what goes into that cost of goods sold and what doesn't. You can have changes in mix of business, and that's partly what we're seeing in terms of Nestle here. They sold a number of divisions and did some and bought a number of different things, and you can see that their gross margin actually dropped a lot, but that's largely due to changes in products. And so you can find that there can be, that whole gross margin. It's actually quite difficult to do that over a whole sector. Well, sorry, it's easy to do it over a whole sector. It's difficult to actually come up with numbers that are reasonable for a whole sector. So, but I don't mind looking at individual companies, on this basis, with the view that we can look at the acquisitions and things they've done and changes in the business model to understand these. But I guess the important point for these guys is both their operating margin and their gross margin, over the last year or so has been falling away. If you look at Unilever, so another big sort of packaged good company and putting these ones out, same story again. Gross margins down, operating margins down. It's not the case that they're out doing it. And even Coca-Cola, same story. Yep, you can look at the last year or two and see this spike in terms of some of these margins, but the fade is certainly happening, and is not so it's not the case that you can just blindly buy these companies and expect that you're going to get this great sales growth and great EPS growth. Now, for the large part, their growth hasn't been bad, and you usually expect these companies during if we're expecting quite a reasonable downturn. We've spoken about the credit crunch a number of times, so we are expecting the earnings on these companies to hold up relative to other companies, but there is certainly already leakage in terms of this, and the answer is not that these companies are making lots. So what is the answer? That's because we've sort of gone, it's as much as we're saying it's greedflation, if it was greedflation, it should be showing up in the numbers. The answers really for me could be, one is maybe the companies are trying to maybe they're genuinely trying to hide it a bit. Like they might be trying to bring forward expenses or capital expenditure and call it ordinary expenditure, and things that they might have otherwise put onto their balance sheet, and so they would have reported higher earnings. It might be that we are just going through that whole transport issue and transport and packaging and other things that did have high price rises. It might be higher management salaries maybe, or patting themselves on the back for great sales targets and paying themselves more. But I think that the net effect for all these is that most of the sales is not flowing through in the same way you'd expect it to the bottom line, and so it does lend to that idea that maybe there's this delay, and as that delay finally gets through, we could genuinely see some quite large price drops. But it is still relatively mysterious as to why we haven't seen those already. And while this whole price over volume idea is certainly true, I don't want to say it's not, because it's not it is happening. If you're increasing your sales by so take Coca-Cola, you're increasing your sales by, I think it was 13% or something, and your dollar worth of sales, but you're actually selling less Coca-Cola, you would expect that your gross margin is going to go up. You're producing less and selling it for more. There shouldn't be a reason for your gross margins to be shrinking. And so it is still, if that's the packaging, if that's the transport, then that is something that's going to come out soon. We'll definitely see these companies try to hold on to the price rises they put through as long as possible. And that's where we're very much on that. From an investment perspective, you really want to be looking at the quality companies where you can look and genuinely think, well, will Coca-Cola have to give back all its price rises, or have they got a strong enough brand that they can keep most or a lot of those price rises? And then as potentially these costs come through, the cost falls come through, that will actually help their margins stay high-ish relative to others. Anyway, but let's get on. We'll do the investment implications after we talk about the question of the week.
Yeah, that's one demo. So question of the week for this week. This is for viewers to have some discussion in the comment section over the coming days. So this week, the question is, why do you think grocery inflation is so much higher than food inflation? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And Damo, just a question sort of back on that previous point that you just mentioned there. So let's say it is a bit of a mystery still, and the most likely, well, maybe not the most likely, but a good theory is, it's just taking time for costs to flow through, but it's not being reflected in the bottom line. So when do you think we might know? When will the story become clearer?
I would think over the next 6 months, we're going to get the answers from companies as to where it's coming from. I think there's, but the danger as well from that is that there's two different factors going on. So on one side, what we're looking at is we've had this sort of big pig in the python, so to speak, coming through in terms of higher costs for transport and packaging, and a little bit wages, but that's coming through, and now we think that should either be passing out of the system, or it should have either already passed or certainly be moving through. The actual food costs should be mostly have moved through the system already, because those ones are while again there might be some contractual things where they're forward bought things. Most of the food stuff should move faster than, say, your packaging in terms of your cost. Your packaging you can buy earlier and gradually work through it, whereas your food will spoil, and so you need to sort of buy that and get rid of it. So there's that front, and then what we're looking at is sorry, I've lost my train of thought there for a sec. So we're talking about how soon before it affects profits. At the same time, though, what we're seeing is we are seeing some relatively strong signs of this credit crunch coming through, and so that's where the issue about if that starts to slow up the top line, so this starts to slow the sales growth because we start seeing higher unemployment and other factors starting to flow through the economy, then you're going to lose some of this in the mix. So you might see that companies can hold their profits up a little bit, but it might be that they've got sales falling by a few percent and they've got their costs falling by a few percent, and managing to keep their actual profits from falling because they're doing that. That's, I guess, the hope within the consumer staples sector. The danger in some other sectors, the more discretionary sectors, things like cars and other things like that, is that the cost falls won't be enough to offset the sales falls. And so that's our argument really at the moment, is we really want to be looking for companies where if we run into this recession, that your profits won't fall as much as other companies. Because if we're looking through at profitability, and we did that last week and the week before, and actually we just posted something on online at the moment, is that the fourth quarter earnings for companies is still forecast to be about 10%. And whereas we have a bond market that's talking about a recession and needing rate cuts by then. And so, there's definitely a disconnect there, and we do think that the analyst forecast will need to come down.
Okay, nice one. So on to investment implications.
Yeah, that's right. So same story as last week. Bonds and cash mainly. The exposures we have are very much in terms of quality stocks and defensive stocks. So very much looking for companies where we do think the price will hold up. In terms of defensive stocks, again, it's being quite careful about which ones we choose there. So, for example, commercial property is not an area where we're looking for defensive exposures. Sort of our property exposures are more in things like the cell phone towers or public storage units and things like that, where we can still see some value and expect to hold up a little bit better than commercial property. We're avoiding growth and value with a view that at some point, once we start seeing some more price falls, we'll switch back into those growth and value stocks. But we'd love to do it at lower rates, and that's why we're holding bonds and cash at the moment.
Excellent. And just for the viewers, there are some ways to take advantage of these themes with the screens and tilts. So depending on which way you think things are going to go, whether you think inflation's going to stay high and companies are going to be able to hold on to these margins, and that'll translate into profits, or if it goes the other way, we have a agribusiness tilt. There's global consumer discretionaries, luxury goods, logistics, and consumer staples. So there's around 100 different tilts and screens to choose from. Just a few ideas of how you can tilt your portfolio to take advantage of these themes. So that pretty much wraps us up for today. So Damo, thanks for sharing your views as always, and I'm sure everyone's looking forward to next week already.
Thanks, Sam.
Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. If you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next week. Bye for now.